welcome to the Masters of Real Estate YouTube channel. My name is Mathew Owens. I'm here with a good buddy of mine, Anthony Walker. He is literally a real estate gangster when it comes to multifamily properties and really focuses quite a bit in the California market. I do a ton of stuff, of course, out of state, as you know, and at the same time, you have focused quite a bit on California. And, I've been a proponent of out-of-state investing for a long time because I like a lot of the cash flow markets and things like that, but you've really been able to figure this thing out in the California market, and I highly respect you for that, and you know the math so well when it comes to multifamily. And I wanted to share a little bit about what your thoughts were of the California market as a whole and why you think you've done so well in California. Like, what are the benefits associated with California multifamily that you see over a lot of other markets and over other asset classes and things like that?
Oh, first of all, thanks, Matt. I appreciate that.
No worries, man.
Yeah, I know bucking the trend for a lot of people here investing in California versus out of state, which is very popular, but
right.
We've done really well with it. So, I think at the end of the day, a lot of the problems that people point at in California are the same things that cause you to do well over a long period of time, right? So we talk about rent control and the legislative environment and all that kind of stuff, but those are really symptoms of what makes investing in California work really well. So at a super broad level, if you think about it, we have some maps over here on the wall, but here in LA, we're surrounded by ocean on two sides, mountains to the north, 100 miles of city to the east. We have the third most productive metropolitan economy in the world, and it's impossible to build anything here.
So just the scarcity of the land alone in the first place and the population density, you probably have tons of tenant demand nonstop, right?
Yeah, I couldn't have said it any better. I mean, that's a recipe for having a great time as a landlord, even if it's really difficult to operate. I mean, we've seen insane rent growth over the last few years, like a lot of places have, of course, during COVID. But even now, as the market's starting to shift, vacancy rates are super low, units are leasing just over the weekend, rents are higher than I've ever seen them be, and it's just super easy to fill units. And so if you own stuff for a while and you can take advantage of that, sure, the cap rates might look terrible on the way in compared to what you're seeing elsewhere. But over a long period of time, if you can manage your return on equity and you can leverage appropriately, you also get some of the best financing terms in the nation. You can do really, really well, and you can create a giant sum of equity that you can use to then deploy and buy more.
Okay, and I think from my perspective, I go into a cap rate and I might be buying at like a 6 cap out of state or something like that right now, where I might be able to improve to like an 8 cap or something along those lines. But that's a slow, steady growth over a long period of time, and there is no like major push up. It's a slow, steady push up and a slow, steady push down with very low, I'd say, volatility in comparison to the California market. At the same time, it seems like California is always having this really strong rent demand, and so maybe if you're going in at a 4 cap or something like that just doesn't look good with the financing initially, and you're having to lower your leverage ratios, but you're able to really push those rents, and you get so much more bang for your buck on your value add strategies, right?
Oh, completely, yeah. So if you look at the math in there, right, we're going in at, you're probably about a 4 cap, maybe we're doing value add up to mid 5, sometimes a 6 if you get a really good deal, and then you own it for a while and that rent growth starts to kick in, and so you've made all this money from increasing rents. If you look at it on a GRM standpoint, maybe a little bit easier to understand. If you're buying stuff at like say 15 times gross, for every $1 of rent revenue you increase on your rent roll, you add $15 to your value, which is probably not what you're seeing in a lot of other markets. And then on top of that, if you look a few years back, I'll look at some of my buildings I bought even like 2 or 3 years ago, and based on my purchase price plus my renovation capital, they're operating at like a 9 or an 11 cap for me now.
Based on your cost,
Yeah, based on my cost. So that's a pretty good recipe. And then like you said, there's just so much demand for the land, for the units, that it's a really insulated place to be doing business as well. I'm feeling really good about that right about now as the market starts to be turning,
I can totally understand that. And I think I think there's something to be said about that, rental increase, because if you're looking at like a 9 cap or even an 8 cap or improving to a 7 cap, you can probably refinance and pull most of your money out of that project, if not all of it. Right. So your risk really is minimized from a capital perspective when you're putting your money in. And I think, a lot of the things that people are concerned about California are, the rent control things you're seeing, right, and the tenant landlord laws and the issues that may come up there. I know there's some ways to mitigate some of those issues, sure, of course, and looking at what do you think the rent control laws here actually do to you as a landlord, and what is the true thing that actually occurs versus what the perception is?
Yeah, I mean, the perception is the government calls all the shots and you have no control and they're going to give you property to the tenants, right? I get that. And there's varying jurisdictions here, and it's different in LA than LA County, than the rest of the state, and so on. But I think at the end of the day, the truth is it just slows you down a little bit. Mm-hmm. It used to be, before we had a lot of this stuff, before we had statewide rent control, you could buy a building, right, you'd raise rents all the way to market, mm-hmm, in the first month, and then you're done 6 months later. Right. Those projects are taking sometimes 18 months, 2 years, even 3 years to execute. Uh-huh. So you do have to be a little bit more patient. You have to realize kind of what it's going to take to get the rents up over time. Mm-hmm. But it results, I think, in lower renovation capital, because it's easier to have people stay in place and just, right, pay the higher rents as you increase them. Mm-hmm. It, unfortunately for the renters, doesn't help them, so it exacerbates the supply problem, mm-hmm, which, mm-hmm, then pushes rents up even further. So as you own them, the rent control actually ends up creating more valuable properties over time.
Ah, interesting.
We actually did a study a while back that compares city of Los Angeles to some of the surrounding cities, uh-huh, that didn't have rent control, okay, when LA rent control started in 1978, mm-hmm, and it appreciated more than the surrounding cities over a period of about 6 or 8 years. I can't remember, okay, what the time frame was, but it's really interesting what it does to distort the market. So I would say it takes longer to execute. You have to know what you're doing. Okay. But I think the end result ends up being fantastic. It's a great place to own property.
It's really interesting when you look at the long-term wealth building effect of that and the slow, steady progression of the increases over a period of time. Real estate, a lot of people think, hey, it's based on that improved value now. And a lot of times, like you said, you get that bigger bang for the buck, but it's that long term too, that hold strategy that really creates the wealth long term, right? Totally. That initial year of cash flow or first few years of cash flow is really not what it's about. No. And what I really like about it is the fact that you're looking at a much higher rent dollar figure, totally, in dollar figures. And so, you have your underlying expenses, but in some of these out-of-state markets, if you have a $600 a month rental, right, versus a $3,000 or $2,000 a month rental, right, in California for the same size unit, you're looking at an increase exponentially if that rent increases by 10%, right, versus the 10% on the $600 rental, and your expenses are staying relatively the same. Right. Now, obviously, taxes and insurance can climb over time, but relatively to the overall revenue, it's very minor of an increase when you're talking about that major increase. So you have to understand those kind of intricacies when you're looking at the true cash flow increase, right, on those assets. And I'm touting California real estate, even though I invest out of state. Yeah, exactly. I'm like, what's wrong with me? It's mostly because I've seen this on a lot of my family's properties, right, and I've seen the consistent increase in those values, even though the taxes are horrible here and things like that. Property taxes are great. Yeah. But so it's and you might go to Texas and have low income taxes, but, right, property taxes are absolutely horrible, and you have to consider those when you're looking, right, at your cash flow strategy. And they're not all as bad as Texas specifically in these other markets, but there's other issues that come up on properties, of course. The weathering too. At the end of the day, when you're working in California versus some of these outside markets, you have a lot less weathering issues. And, right, I'll tell you, working out of state, the water intrusion issues,
huge, right?
Man, on the roof, on the foundational issues, the basements, that the water intrusion. I mean, you're lucky if it rains here twice a year, right? So,
well, and you touched on some really interesting stuff there with not only the weather, but as you mentioned, the rent per square foot that you get here is so, mm-hmm, much higher. That has implications in your major implications in your expense ratios. Mm-hmm, mm-hmm. And so you might have a building here that it's perfectly normal to have a 25% expense ratio, uh-huh, compared to revenue, right, whereas it's got to be 50 pretty much everywhere else.
Sure,
right?
Yeah.
And the implications for CapEx are incredible too.
Right.
Because these are if a tiny building is still generating $10,000 a month in annual rent, mm-hmm, The roof on that building is only $15,000 compared to a $10,000 a month building somewhere else.
Right.
It's so much easier to improve properties here. We have great labor pool, and so people don't see a lot of these sort of hidden benefits to investing here that actually are a result of the distortions created for it being an expensive property market. It's kind of hard to, put those links together, but it's there for sure.
I think one of the other things that I'm seeing right now as a value add play in California, obviously there's a major problem when it comes to the supply of homes, right? And that's why you see some of these rent control practices and the politicians pushing this stuff. And at the end of the day, they are making incentives to be able to add additional units, potentially add additional dwelling units to your property, even on single families, but that also parlays into multifamily too, right? That's a potential value play if you have any extra land.
Absolutely. Well, and the most popular way to do it around here is garage conversions.
Okay.
So these are for accessory dwelling units, ADUs.
Okay.
And basically by right, if you have a medium-sized apartment building, you can add 25% of the existing unit count out of currently non-occupied, non-living space, basically.
Okay, that makes
so
sense.
any of those old 60s buildings with the tuck under parking, you're kind of solving two issues there. You're getting your earthquake retrofit out of the way, and you're adding units at the same time. And then going back to your earlier point, if you're adding an ADU for not that much money that's going to rent for $1,600 to $2,200, the value add you get out of spending that money on the construction is enormous, especially if you're doing it in some of the nicer areas.
Right, if you're looking at a 4-cap property and able to increase revenue by that, just looking at the exponential aspect of that. And I would assume that, looking at these, there's other potential plays if you find the right types of units that maybe they're 3-bedroom, 2-bath units or something, and you can potentially break them up or being able to, depending on the layouts. And
right, that
of
gets
course,
harder.
yeah, for sure. And you're looking at a major renovation on that.
Right.
But I think just understanding that you can break these up into multiple units or be able to do that for a few units that might be unique or something like that is key. Totally. I know on a lot of my family's properties here, there are big garages. There's 1,500 square foot, 2-bedroom, 2-bath units that could easily be turned into a studio as well as a another 1-bedroom, 1-bath unit or something like that. And it's interesting to see the types of opportunities that actually are here for that, and the ability to raise rents if you do your value add is there, and that bang for your buck is absolutely key. So I love the content, man. I love the knowledge base and the fact that you're doing the analysis and the data on this stuff consistently and really diving into that. And if anybody's interested, Buckingham Investments is the way to go. If you guys like this content, please like, subscribe, hit that notification bell, and we'll be coming up with tips and tricks on real estate investing for you guys, just to add value and help you guys create financial freedom in your life. Thanks so much, Anthony. I appreciate it. And what's your website, man, for everybody to know?
We're at buckinghaminvestments.com. Come check us out, and we'll help you learn, plan, and invest in multifamily right here in Southern California.
Awesome. Thanks, man.
Yeah, thanks.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.